Today I want to talk about how understanding macroeconomic trends in real estate, specifically residential real estate, can help you in your investment business or your lending business. My background, 20 years ago, I started my first real estate investment company. I was 19 years old, Velocity Real Estate LLC in New Hampshire, and it was the mid-2000s. So I had my first multifamily deal under contract when I was 24 years old, and that was in the year 2008. Anybody that knows anything about modern real estate markets knows that 2008 was the year when everything went from up and up and up from 94 until 2008. Real estate, for the most part, was appreciating. And in 2008, due to a number of economic forces, mainly in the subprime mortgage real estate market and underlying commercial securitization that was happening behind the scenes, and lack of regulation, they say that's up for debate, but that's something that has come as a result of that, is further regulations from the federal government. Everything tanked. Luckily, I didn't actually close on that multifamily deal, but it gave me an insight. I was very active in local real estate investment associations, and I saw a lot of knowledgeable, competent real estate investors completely lose their shirt and take years and years to recover back their net worth and what had happened to them from 2008 to 2012, when the markets were either flattening out or going down in many cases. So I wanted to explain how understanding macroeconomic trends can influence people's local real estate markets, their businesses. I look at it through the lens of a private money lender now, and all of these principles are very relevant. One thing that I want to talk about is real estate is local. So often we will hear national real estate trends. We'll hear about supply and demand, which at the very basic core, supply and demand is what fuels many businesses' success, strategy, or failure. And I want to bring that also down to the understanding that real estate is very local, especially for many investors who are smaller investors, single family or small multifamily real estate investors typically will be investing in their own market. That's not always the case. Even if one wants to invest in another market, principles of understanding the local real estate markets are very important. My point is that understanding macroeconomic real estate trends on a national level is important, but in real estate, it's much more important to be able to look at a local real estate market and boil it down to what's happening in that market and try to best hedge risk by trying to at least predict what is going to be happening in the coming year, 5 years, 10 years within that given market that you're looking at investing in. Another principle that I've learned in my 20 plus years in real estate investing and adjacent businesses and companies. I've had a property management company. I've owned contracting companies on and off, most of the time working for other real estate investors, is that we don't know what's coming. No matter how smart an economic educated person is, I've seen PhD economic professors and analysts make predictions about what's happening in the next year or 5 years and just be completely wrong. 2008 financial crisis, there was a very, very small number of people who understood what was happening and saw it coming. COVID was another example of what I've lived through personally that nobody saw coming. So there are complexities in the economy that nobody can predict. But the best that we can do as investors and as real estate private money lenders is to try to mitigate the risk the best we can by understanding the economic factors that influence the real estate investments that we get involved with. So To bring it back, supply and demand is at the most fundamental level what affects real estate prices, valuations, the trajectory of prices and valuations. Supply and demand for rental units affects landlords' bottom line through net operating income, and will affect the cap rates and the values of more commercial, residential, rental real estate. And so let's talk about supply and demand and how to analyze that at a national level, but more importantly, at a local level. So the economic factors that influence on the supply side, what you need to look at is inventory. In other words, how many units are in any given geographic region. Talk about inventory rate is a really important way to be able to look at any geographic region and understand the snapshot of what's happening from a supply and demand lens in that geographic region, and also the way, the momentum that it has, either moving more towards a buyer's market or a seller's market, which is very relevant in understanding the potential profitability, or if you have an exit strategy as a house flipper, for example, what that might look like in 6 to 12 months after your project is done for doing a retail exit on that. And so what inventory rate is the rate at which real estate is selling. So let's talk about single family homes, for instance. If you have a geographic region that currently has 100 houses of inventory, so there are 100 houses for sale, if the houses are selling at a rate of 20 houses per month, you take 100 divided by 20, and that is a 5-month inventory rate. So the precipice at which it goes from a buyer's market to a seller's market, if there's less than 6 months of inventory, it's considered a seller's market. If there's more than 6 months of inventory, it's considered a buyer's market. If you look at the trend of what's been happening for, let's say, the last year or the last 2 years, I would say, in order to dictate a trend of inventory rate, you're going to want to at least look at a year, 2 years, and you also need to understand factors that are influencing that, such as presidential elections. COVID, for example, was a big one. Those can all influence it. But you can look at the inventory rate as it's been changing. So if the inventory rate today is 5 months of inventory, and a year ago it was 2 months of inventory, which would be a pretty hot market, you can understand that market is softening. And again, as a house flipper or as a lender, you need to understand this market's softening, and we need to start taking measures to prevent any risks from happening. So for example, if you know that this market is softening, as a lender, you can say, well, we're going to need to start collecting more of a down payment, and we're going to need to start really analyzing our client borrowers' track record. Have they been through a market like this before that is softening? And just start to take measures to hedge the risk more. From a flipper's perspective, if you're going into a softening market, you're probably not going to want to take as many long-term renovation projects. If you do extensive renovations that take 9 to 12 months to complete, and the inventory rate has gone from 2 months of inventory to 5 months inventory rate, you're probably going to want to only take on projects with shorter renovation projects so that you're not getting swept downriver with the softening market and the devaluation of your asset over a year that it might take to do a longer term renovation. So that's one example of how you can mitigate risk is and understand the inventory rate in order to make that relevant on your closing into it side, and when you're analyzing deals as a flipper and underwriting deals as a lender, is to say, okay, what is the picture of this market? Where is it heading? What economic factors are influencing it? And you can start to adjust your strategy based on that. So moving on to the next section, let's talk about on the demand side. So typically when you're looking at a product or a market in business in general, you're looking at what's called perceived value of a product or a service in any given market. The good thing about real estate is there's a perceived value, but there's also a very real need for shelter. So it's one of the basic needs. And so when it comes to the demand side of real estate, a shelter, a roof over someone's head is always something that people are going to need. It's a tangible asset, and people will always have a need for it. In other words, even if the economy completely crashed and, for example, unemployment rate, let's say, went to 30% or 40% and the dollar completely devalued, the closer you are to actually owning the tangible asset, in this case real estate, the better off you're going to be in a scenario like that. In other words, you are hedged against some worst case scenarios in the economy. So what that means in that example is you could always, if you own an apartment building or a single family house, you could literally trade someone for if they had food or something else of value in order to live in your real estate. Where if you are more removed from the actual asset in the form of derivatives of the asset, like stocks, or in the example of a real estate investment trust, if you just own stock in a real estate investment trust, you're further removed from the asset, and so you're not in as good of a position to hedge your risks. The closer that you can be to the tangible asset, the better off you're going to be. So let's talk about how you can look at different economic indicators in order to best try to predict what's going to happen in a market. So what are we looking at if you're looking at your city, or you're looking at investing in a city in another state or your state, and you want to say, how do I analyze the health and the risk and the volatility and the trajectory of this market? The basic numbers that you want to look at are the population growth, what's happening, the demographics, what age group, are people moving into apartments, are people going there to buy single family homes. Job growth is a big indicator of the health of the market. If it's low unemployment and a robust job market where the local government, the state government is providing a lot of incentives for businesses to move there, you're going to typically see real estate appreciate. Now that's an oversimplification of exactly what will happen, but an example of that happening right now, you're seeing people move out of California. In my perspective, the cost of taxes there is driving people out of the state, driving businesses out of the state. Same thing with New York. And you're seeing an influx of people going into Central Texas, for example. And so on a long-term trend, you're seeing Central Texas as a whole go up. Again, that's an oversimplification. Austin right now is actually down 20% in values of single-family homes in the last 24 months. But that is because it got a little bit too inflated. In the coming 10 years, I still believe that Central Texas has really strong fundamentals, and in Austin will come back around, but right now it's kind of on a downward trend. So one of the things that you can do when, as a flipper or as a lender, private money lender, one of the things you can do to mitigate your risk is when you're looking at these deals and you understand, okay, things are starting to flatten out, which is what's happening right now on a national level, we can start to look at cash flow of an asset. So from a flipper or a lender perspective, if you're going into an investment, for example, a single family flip project, and you're looking at a 6-month renovation, for example, and you want to do a retail exit where you're going in, value adding through renovation and selling it on the retail market to a home buyer, a homeowner, what would be the plan B in that scenario if you were unable to sell it for how much you wanted? So as the flipper, you may have to pivot and rent that out instead. So in the case of investing in a market that's going down and you're not exactly sure what values will be in 6 months or 12 months, and there's a chance that that could really eat into your profitability, you want to then look at, well, how much could I rent this out for? And am I in a position to refinance if you're utilizing a short-term private money loan? Am I in a position to refinance into traditional financing and make this property cash flow? If you're not, and that market is softening, again, from a flipper or a lender perspective, it's questionable if you're going to want to get into that. From a lender perspective, you need to cover your bases, and most lenders know that you don't want to get into too high of a loan-to-value ratio. And so if you're in a macroeconomic situation where you're seeing a softening market, then you need to cover your bases through more skin in the game from your borrower and just having a diligent underwriting process of underwriting your borrower to make sure that if they did need to go into a refinance situation in order to rent it out as opposed to their retail exit, if that fell through, that your borrower would be in a position to do that, for example. So overall, from a macroeconomic supply and demand perspective, since '94, the peak-to-peak timeline, you typically have a 12 to 16 year timeline. So from 94 to 2008, things were pretty much going up. That was a 14-year timeline of appreciation in real estate. And then things flattened out from 2008 to 2012. They flattened out or went down. In some cases, went down dramatically. A lot of the times you see coastal cities from the East Coast to the West Coast will have greater fluctuations up and down. And so you'll see appreciation going up higher. And then in the case of 2008 to 2012, we saw the coastal cities drop down further and faster than the central part of the United States. And so typically that is the timeline cycle. So we had from 94 to 2008, it flattened out from 2008 to 2012 and went down in many instances, many submarkets. And then from 2012 to 2020, which is when COVID hit, we saw appreciation of real estate happening. Again, depending on the submarket that you're in, depending on the region you're in, this is just national trends. But for the most part, from 2012 to 2020, we saw appreciation. And then in 2020, there was a big hiatus of appreciation because nobody knew what was going to happen. And then we saw some interesting trends that people were wanting to move out of the city because they were afraid of the virus. And so some markets actually exploded. I know Montana was a market that in 2020 people were just flocking to. They wanted to be in nature and in less population dense areas. And then through 2021, 2022, there was a lot of question marks. Different things were happening. People were staying in their homes and renovating. I had a contracting business at that time and had a very strong 3 years in the contracting business. And then in 2022, 2023, interest rates went up and we saw a sharp drop in home sales. And so in 2024, there are question marks as to what will be happening in the coming year, in the coming 5 years, 10 years. And so, again, what I urge is that you use these economic indicators to look at specific local markets instead of just trying to predict what the entire country will do as a whole. Zero in on different regions, different cities, and submarkets to figure out what your next best market might be. So, for instance, in Florida and a lot of places, they're having a catastrophe around the insurance because insurance rates are going through the roof due to all of the hurricanes that happen there every year. And you're seeing insurance premiums at $500 to $800 to $1,000 a month or more, which is making home ownership completely unaffordable for people down there. In some cases, especially on the coastal areas. I don't know a lot about the submarkets within Florida, but that's just an example. I am positioned in North Carolina right now. I reside in Asheville and am in the Charlotte area and the Raleigh-Durham, Cary area. They call that the Research Triangle around Duke University. And North Carolina is poised for strength and growth in the coming 5 to 10 years because of the population growth and the strength of the job market here. Atlanta is another market that's posed for growth. Central Texas in the next 10 years, again, Austin is down right now. I'm originally from New Hampshire, which southern New Hampshire is effectively a submarket of Boston. I grew up about a little over an hour north of Boston, and central New Hampshire, the capital, Concord. And typically what we've seen in the New Hampshire area is quite a bit of stability right through the 2008 crisis through 2020. Not necessarily the Boston market itself, that tends to fluctuate up and down, but southern New Hampshire has stayed fairly stable just because of the dynamics that it has. When Boston gets very expensive, people will migrate north a little bit, and that keeps the market somewhat strong. And southern New Hampshire typically keeps a strong job market. Unemployment has never spiked too high there. So my point is that to understand macroeconomic trends, supply and demand, you can hone in on what's happening in your market, understand it, understand where things are going, and adjust your strategy based on that. So there's always going to be deals in any given market as a house flipper or as a person who's looking to buy real estate and hold for rentals, or as a lender who's supporting these investors. In any given market, it's, real estate is local and it's based on submarket, but even more than that, it's based on individual deals. So there's always going to be deals in markets. However, understanding these market trends will help you to better position yourself and help your bottom line, because even though there may always be deals in any given market, if you position yourself correctly, it's going to be easier to find deals. You're going to have less risk if you understand, well, this market is actually increasing in demand. Inventory rates are going down right now, and even better if you can get ahead of it and understand that, okay, things have gone down. Typically the perspective of the general population is 6 months behind what's actually occurring in a given real estate market. So, for example, in the last year, 2 years, when interest rates started going down, actual valuations of real estate may have been flattening out, even heading down. But if you were a house flipper and trying to negotiate on a purchase, people are saying, well, my neighbor's house just sold for $450,000 3 months ago. that's what I want for mine. And they didn't really understand that things have headed down because of interest rates. And so to understand these macroeconomic trends and be able to see what's coming in the next 6 months, year, 2 years, 3 years, 5 years, you can position yourself in a much stronger place and adjust your strategy to be as successful as possible. So I hope that this video helps you guys. Let me know if you have any questions. Again, real estate economics, economics in general are very complex topics, and there's a lot that goes into it, and I will be curious to hear if anybody has any insight on anything that I've said. I'll be curious to hear if you're an investor or a lender, how you use macroeconomic trends and data to best adjust your strategy, find your next market, and make your business as successful as possible. Thank you guys. Appreciate you.